Welcome to Kitco News. I'm Niels Christensen. We're seeing some significant selling pressure in the gold market today as prices fall near to a 1-month low. Better than expected economic data is impacting gold's safe haven interest among investors. Here to talk about his outlook for the gold price is Bart Melek, Head of Commodity Strategy at TD Securities. Thank you very much for joining us today, Bart.
Hey, great to be here. Thank you for inviting me.
So lots to talk about today. Gold prices below $1,700. Your latest report, you actually said, investors should maybe wait until next year to see record high prices. What are your thoughts that we're seeing right now? This move between deflation and inflation.
Yes. Well, what we're looking at today, for example, is we've had ADP numbers a little bit better than expected on the employment front, and we continue to see an awful lot of risk appetite. All that is translating into somewhat higher yields along the curve. And essentially, what this means is that real rates are up a little bit today. And given the fact that we are still expecting pretty significant unemployment in an economy that will be very much underutilized, for at least a short while, we could see disinflation building, meaning that the combination of risk appetite, higher nominal rates for now, and somewhat lower inflation means there is really not a huge amount of appetite for gold. And certainly, I suspect there might very well be some profit taking from what, let's face it, a fairly crowded trade for now.
Mm-hmm. So, what do you think? I mean, looking at the second half of the year, where do you are you worried about the rally that we've seen so far? At what point, if we're not able to break out of this channel, what gets you worried on the downside?
Yeah. Well, I've published on this, as you know. I am saying, and I stick to my argument that it is going to be a bumpy road to 2000 and plus. We've already talked about some disinflationary pressures building as we have massive amount of unemployment, and we will likely see income challenges for a lot of people. That was not going to help prices to move higher. And at the same time, we could very well see a US dollar that continues to be fairly firm, not allowing for gold flows. Now, beyond those problems in the short run, I do expect continued monetary stimulus and fiscal stimulus. And what that essentially is based on is our assumption that this is going to be one nasty recession and that the economy is going to function massively below potential. And if governments and central banks relied on the normal trends, it would take a decade or so to work off that spare capacity. So we're going to need stimulus. And that means printing money. That means creating debt. And I can't believe that we're not going to have inflation down the road, particularly since we're already seeing the moving back or reversal of globalization, a lot of critical supply chains coming back to industrial countries, which likely means, well, higher prices, higher costs. We will see significant amount of production capacity destroyed by COVID in terms of small business and others. And if central banks continue to accommodate this, as we think they will, in order to get full employment, you will get real interest rates that are quite low and negative. And that is a very good environment for gold in the long run.
So how do you read this environment now? I mean, it feels like equities are a little too optimistic. I mean, we've had 4 straight days of gains in the S&P 500. It does feel like investors haven't really learned anything and sort of setting themselves up for another fall. What are your thoughts?
Well, it's a good thing I'm a commodity strategist as opposed to equity strategist, so I don't want to comment too much on equities. But it certainly seems that this is very much a liquidity-driven rally where we have the Federal Reserve injecting massive amount of money. We are continuing to hear again that there may be more fiscal stimulus from various governments around the world, and I'm here thinking particularly of the U.S. And let's face it, there is now a Powell put. There's a floor under this. The central bank is buying corporate paper. It's buying government paper, and that has just reduced a lot of risk factors in the equity market. And if you continue to see massive buildup of balance sheet, I'm not particularly surprised that equities now in the S&P 500 are 3,100 plus, not far off the highs we've seen before COVID-19. I'm not sure I'm qualified to say whether this is good or bad, but I think as we move past these levels and maybe start approaching previous highs, there is going to be a sentiment change where the balance of risks are going to be on the correction side as opposed to on another big rally.
So gold faces some headwinds with equity markets and sentiment in the marketplace. What levels are you watching right now? Like how low can this go? Where is 1800 going to be the resistance point to really watch?
Well, I've said that we are probably going to straddle the lower bound of the recent trading range, and we could go another $20-$30 below where we are. I think, or just under $1,800 is where we have strong resistance on the upside. So for now, I think we're not going to get any drift significantly lower than the lower bound that I was referencing, mainly because in terms of policy and expectations, nothing drastic is really going to change. So we are going to straddle that bound. If we have negative CPI prints and fairly surprising data, it's still going to be terrible data, just not as terrible as I think some thought. There's good reason to believe that we might get more risk appetite. But that's particularly unreasonable, particularly if we don't see any feared inflation. And I think you need a specific set of things to happen for inflation to occur. It will occur, but we're going to have many things happen before that, and that will include more stimulus. We see the central bank of the United States increasing its balance sheet to $12 trillion by year end. So that's one. We're going to need some stability. Once that happens, we will probably start seeing stabilization and higher prices. And if we do start seeing inflation and statements from the central bank that they are really, average targeting as opposed to just having, automatic response to 2% or so expectations, then we see an environment where gold could easily move past 2,000.
Let's switch gears here for a second. You wrote a recent report calling silver an explosive trade or potentially explosive trade. What do you like better, gold or silver at this moment?
Well, they're both precious and shiny. I love them both. But I think in terms of what will likely outperform each other, I think most likely silver will do better. Typically, silver does very well in times of a positive precious metals environment, and I think we're entering one. So silver has several things going for it. It is really, really cheap relative to gold historically. It's not as cheap as it was a while back where we went well over 100 ratio, gold to silver, but it is still fairly cheap. So there is some potential gains just from that. As things normalize, we could see that ratio go a little bit lower to more of the historic norms. So that gives us a few bucks. I think, even at $1,700, when you take an 85 ratio, we should see a two handle on silver or somewhere around there. Another good thing is as COVID-19 impacts start to fade, we will see a return of industrial demand, which is, 66% or so, well over 60% of silver demand. That will tighten up physical markets. And of course, there's the very strong positioning of investors into silver. I think that continues. So the combination of strong industrial demand, firm investment demand. And let's not forget, very weak supply side, meaning we're going to likely have physical deficits with people unwilling to part with inventories. And that should create tightness. And that is a very good recipe for higher prices. So at this stage, I think silver is slated to do very well because it's cheap and it is going to have very good fundamentals.
Thank you, Bart, for those optimistic comments in what's a fairly negative day for the precious metals market.
I'm happy to help you.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.